Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. FOMC members differed over what to call the first rate cut in a decade, show minutes of the last meeting. A 35 basis point cut from the Reserve Bank of India was aimed at showing urgency for banks to pass on the rate cuts, according to the minutes of the last MPC meeting. SEBI board approves tighter norms for mutual fund investments while relaxing rules for foreign portfolio investors as proposed by the HR Khan panel. And the CBI takes former Finance Minister P. Chidambaram into custody to question him on the INX media case after high drama at his residence last night. Yes, indeed, that was the talk of the country last night. But let's take a look at the trade setup for the day. It's a fresh day of trade. Remember, all eyes were centered around what the FOMC did, or the minutes from the FOMC showed, or the minutes from the RBI MPC showed as well for traders back home. Now, keep in mind, the larger point being, when you look at what the Fed minutes showed, it showed some diversity in opinion that came in from the US policymakers. So there were diverse views from all the policymakers, leaving little clue for the emerging market traders. And I think post this, all eyes will be out for Jerome Powell's address at the Jackson Hole Symposium. Would he sound a bit more dovish than otherwise? In fact, a lot of global websites also put out their opinion pieces about whether the Fed is behind the curve when it comes to cutting rates. So I think the extent of dovishness in Jerome Powell's commentary this Friday at the Jackson Hole Symposium would be what almost all traders, both US traders as well as emerging market traders, would be watching out for. Well, what did that do anything to the US markets? Precious little. In fact, some companies came out with good earnings and that drove sentiment as well. So the US markets ended very, very well, up nearly 1%, a strong tinge of green, hardly any buckling down under pressure in yesterday's session. But is that doing something to Asia? No, not quite. It's a mixed bag of trade out there, large bias towards the downside, but the flattish moves, Hang Seng, Nikkei, Shanghai, all of them looking very mixed to marginally lower. The SGX Nifty 2, after the crack that we saw yesterday, indicating some more downside that we may have at the start of the session today, and that puts that 10,900 mark under some crucial threat. If indeed we start off lower and then stay lower below that 10,900 mark, and close lower, then that opens up, I believe, fresh legs of downside if the technical experts are to be believed. So sharp cracks yesterday. The other part about yesterday's session was that while the crack was only about 1%, when you looked at what happened to Nifty 50 constituents, it looked as if, or it seemed as if, the sky had fallen really. I mean, the quantum of cuts onto a Tata Motors, a Yes Bank, and Indiabulls Housing Finance would probably make you believe that the cut would be very, very deep, even though it was less than 1% kind of a move. So, well, very interesting to see what happens to some of these stocks today. There was no apparent reason, there was no apparent weakness. Global markets were okay, but some of these stocks just came off like a pack of cards, really. And maybe some bit of volatility is expected in the second half of trade today as well, because it's the options expiry day. And it'll be interesting to see if indeed there is an uptick that comes in if traders try to defend the 10,900 mark, which is very crucial, or there is heightened volatility in some of these usual stocks come off, then that would be the key focus as well. So watch out for all of these. I don't know if the RBI MPC minutes, and we'll talk about that a bit later on, but I don't know if they really drive animal spirits in the market right now. But I think when you look at what experts are saying about the RBI MPC minutes, I think Indranil Sengupta of Bank of America Merrill Lynch has put out a note after the MPC minutes saying that we expect the RBI MPC to cut rates by 25 basis points versus 15 basis points earlier after the dovish minutes. Our base case has it pausing after that as inflation goes up on base effects, and a 15 basis points cut in February. In case of a US recession, the MPC will likely cut rates by 90 basis points by September 2020. This is Indranil Sengupta of Bank of America Merrill Lynch. The only interesting change in all of these comments now is that rate cuts are not centered around 25, 50, 75, 100 basis points. They could veer between 45 and 90 basis points as well. So that's the interesting change, but clearly some dovishness out there in those minutes too, at least to the eyes of select people. In all of this, or amidst all of this, the stocks to watch, not too many today in terms of news. NMDC, the flip and the flop might be causing a headache for some of the traders, but the High Court has stayed the state government order until the next date of hearing. This is a Donimalai mines issue. They've also cut the lump and fine prices by about 200 rupees per ton due to falling global prices. So watch out for NMDC in the session today. Might see some recovery, I guess. LIC Housing Finance, institutional investor looked to sell about 3.37 crore shares at to raise about $200 million. The offer is at about 425 to 449 rupees per share. So the discount to yesterday's closing, naturally so. Let's see. These days discounts don't last, but that is in stronger stocks, the likes of HDFC Life. Don't quite know if LIC Housing Finance will also recover after that initial downtick that we may see. And on Biocon, JP Morgan has maintained the overweight with the target price of 380. They believe that the value unlocking at Biocon Biologics is likely in the near term, and Fulfilla still an FY 2021 opportunity despite near-term share moderation. So they are selectively bullish on this one with a very stiff target price of 380. Let's see if this note drives some traction in the stock of Biocon in the session today. However, let's tell you what's lined up on First Word today, a collection of the top editorial stories that we want to bring to you. Take stock of what the FOMC members had to say in the last meeting and what markets want to hear from Jerome Powell tomorrow with Seth Freeman. Pallavi takes us through what our own Monetary Policy Committee members had to say in their last meeting. SEBI made some significant changes to FPI regulations and mutual fund investment norms. Sajid Mangat runs us through those. And then Yatin tells us why Tata Motors stock price is back to where it was 9 years ago. FOMC members were not quite on the same page in the decision to cut rates for the first time in a decade. The minutes of the last meeting show that the members were divided over how to project the cut, with some, like the Federal Reserve Chairman Jerome Powell, choosing to call an insurance cut. But what matters more is Jerome Powell's speech at the Jackson Hole Symposium on Friday. Kathleen Hayes of Bloomberg News, who is headed to Jackson Hole, sums up what to make of the latest FOMC minutes.
Minutes make it all the more interesting, don't they, what Jay Powell is going to say in a speech that everyone around the world is waiting to hear. Because it's clear that at least in the minutes, yes, this was viewed as a rate cut to outlook weak global growth, trade policy uncertainty, as you said, but also putting in three reasons for the cut. Signs of economic deceleration, risk management concerns, and too low inflation. Trade uncertainty would remain a persistent headwind for the outlook. There's a lot of talk today about, this was not as dovish as some people had expected. We knew that Esther George and Eric Rosengren from the Kansas City Fed, the host of this event, and the Boston Fed, respectively, had dissented. And, of course, Eric Rosengren explained that at length with me on Monday. But now, remember, July 31st was when they made that rate cut. This is the meeting. This is minutes that sum up that meeting. August 1st is when Donald Trump said, okay, guess what? On September 1st, 10% tariffs on more Chinese goods. I think it will be interesting to see now what Jay Powell says about all the things that happened between this July 31st meeting and today. 30-year bond went below 2% for the first time ever. Yield curve, the most important one, 2s to 10s, briefly inverted. It's still very flat. More negative bond yields, it seems, every day. The Germans just sold a 30-year bond at a negative yield, right? I think that's what makes this speech all the more important. A lot of important things have happened in a very short period of time. How is that going to influence what he says and what he signals about the direction of policy and the risk to the U.S. economy?
Well, that's Kathleen Hayes, and let's get in Seth Freeman, Senior Managing Director at Glass Ratner, joins us right now on the show. Seth, good having you. Thanks much for taking the time out. You reckon Jerome Powell will sound a lot more dovish than what the markets would have thought before the minutes came out?
Well, I expect him to be fairly dovish. It was positioned right now, at least, as a kind of one-time recalibration movement. And it's just not clear that we're going to see a series of cuts.
Okay. In light of this, Seth, with an assumption that Jerome Powell does sound mildly dovish, and a lot of people believing, or a lot of global websites believing that he's already behind the curve. I read a couple of opinion pieces overnight. Just wondering, what do you think happens to the markets in the near term? Because everybody's seems to be bracing themselves for a possible recessionary move in 2020, but believe that the markets will not quite give in just as yet.
Well, it's quite clear that we're looking at a global slowdown, but typically the curve, the inversion, has been looked at as a sign of a coming recession. But it's been pointed out that the yield curve has been relatively flat for some time, and we also have much more dynamic global flows. So it's not being held out, at least this week, as being the indicator of a looming recession. The US economy is relatively strong and it's consumer driven. And in spite of additional retail Chapter 11s as recently as last week, consumers are spending. But at the same time, we are looking at a lot of uncertainty globally.
We are. Professor Aswat Damodaran of Stern, NYU, mentioned that we give the Fed a lot more, or we assume that the Fed has a lot more power than it actually does. If indeed that's the economic scenario out there, Seth, do you think dovish commentary, central banks cutting rates by itself might help economies? I think the IMF economists also put out this note that currency tinkering as well as rate tinkering will not necessarily help economic growth coming back. Does the Fed have the ammo to stave off what looks likely to be a spiral downwards?
Well, a spiral sounds pretty dire.
Okay, let me not call it a spiral.
Is the Fed has fewer and fewer tools when interest rates go down. And at the same moment, we're looking at relative currency strength. As you mentioned earlier, Germany sold negative yield bonds. And these moves in other countries strengthen the dollar, and that makes our goods less competitive. So it has a self-fulfilling type of process over time. And the real question is, are these if the Fed was to continue to lower rates 25, 50 basis points, is that really going to stimulate the U.S. economy, or is all of this sort of baked in already?
Okay, then my final question, Seth, on this topic. Again, it's some bit of assumptions and guesswork out here, but if indeed we project a trajectory post the Jackson Hole address that the Fed likely will be more dovish, it doesn't do much to the economy, but does it do enough for the markets, and would people want to participate in that market? Yesterday we had a guest who said that the construct seems to be that if indeed the rates come off, irrespective of what happens to the economy in the near term, the markets may still rally. Is that a good base case assumption?
Well, the markets are forward looking. And if you look at the futures right now for tomorrow, they're relatively flat. So I don't think anyone's getting too excited. We also have to remember that the conference at Jackson Hole is really an academic conference. It's not a policy setting conference. And we should maybe listen to the nuances that come out from the speakers, but they're not going to be setting policy per se. And I think we're going to really have to wait until the next round of meetings, formal meetings, and as we get closer to the holidays and summer's over, we'll get a much better view, at least of the direction in the U.S. But we can see in other countries, whether it's Indonesia, Germany, they're responding to slowdowns in their economies.
Okay, let's wait and watch. Seth Freeman, really appreciate you joining us today and giving us your thesis on, well, the FOMC minutes and also what to anticipate from Jackson Hole Symposium. Seth Freeman clearly stating, and yes, well known, but maybe don't expect too many fireworks. However, I think the nature of the commentary from Jerome Powell might get the markets excited for maybe an hour or two, Monday, U.S. time. Back home, though, it's not just the U.S. Central Bank minutes. Back home, the Monetary Policy Committee, the RBI Monetary Policy Committee, voted to cut policy rates for the fourth time in the year, and the six-member panel believed that weak growth warranted further monetary easing. But the MPC broke convention to cut rates by 35 basis points instead of a 25 or a 50, which has been usually the case. Pallavi Nahata brings us the highlights from the minutes of that policy meeting to understand why.
The Monetary Policy Committee had left policy watchers surprised when it chose to cut rates by 35 basis points, citing weakening economic growth. The minutes of the MPC meet, which were released on Wednesday, give us some insights into why the MPC cut rates and why it chose to cut rates by 35 basis points. Shaktikanta Das, RBI governor, said that it can no longer be business as usual given the current and evolving inflation and growth scenario, and that the economy needs a larger push. Ravindra Jalakia said that reviving growth required several economic reforms which were not within the purview of monetary policy except for the correction of high real interest rates to a certain extent. Judging the extent of the slowdown is the key issue, according to Michael Patra's statement, which also called for a broad-based policy response involving all policy levers. He cautioned that the space for monetary policy action has to be calibrated to evolving situations from here on. At its August meet, the RBI once again revised growth forecast to 6.9% for the full financial year. Even as reviving growth continues to take center stage at MPC, Chetan Ghate again flagged off possible fiscal risks. He reiterated that large public sector borrowings can be detrimental to the economy. He added that going forward, policy coordination between monetary and fiscal policy will be crucial for a healthier and more durable growth inflation mix in the economy. Ravindra Jalakia countered Ghate's view on fiscal risks, stating that fiscal slippage is not a matter of concern.
Okay, well, we'll seemingly more dovish than otherwise. At least some of the brokerages seem to believe so. Well, thanks to Pallavi for putting that together. The next piece on First Word is another very important event that happened yesterday. SEBI of the board meet concluded and has announced a slew of measures aimed at trying to gap the loopholes and increase participation in equities. But perhaps the most important aspect would be the adoption of the HR Khan Working Group's recommendations on foreign portfolio investor regulations. Now, a lot of questions to me personally as well about whether this is a big game-changing event. Well, I thought it's best to get Sajid Mangat to try and address that. Sajid, good morning.
Good morning.
You were at the press conference yesterday as well. You did this whole show. What stood out for you at the meeting yesterday?
It's more of a easing of processes for the foreign portfolio investors. There have been 3 or 4 major things which has come up. One is the FPI issue. The second one on credit rating agency, and third one is buyback. So I'll take one by one. FPI, on the FPI issue, there has been simplification of registration processes and KYC things. SEBI has been gradually, ensuring that custodians take more responsibility in doing KYCs and checks rather than SEBI doing it. And so the process of getting registration becomes much more easier. Because earlier all the due diligence is done by SEBI, now they want it to be done at the custodian end. So the KYC norms as such has been, remains the same, but the procedures and documentations and other stuff have reduced. And this is what HR Khan committee also was looking at, simplification, rationalization of the process. There was one issue which was raised last year as part of the SEBI's norm on the broad-based criteria for FPIs, institutional investors, especially foreign, that created a lot of issue, and then SEBI had to put it in abeyance. HR Khan committee also looked into it, so that has been done away with. So that issue is no longer there because they were not able to basically SEBI was trying to figure out, is this money being rerouted through Indians or not, and many of the foreign investors were not able to, or custodians were not able to give that answer. Over and about that, there has been some structural changes with respect to rationalization of ODIs, P notes, as you know, the comment, and SEBI has a view that you have to increase the KYC norms, and eventually they want investors to come directly register in India rather than come through the P notes. So that registration and there has been some rationalization which has been done. Now details are still not out because it's still part of the agenda paper. So as and when they are out, you will get to know much more finer details of what rationalization has happened. But major one is the 3 categories of FPIs which SEBI had. Now they have compressed it into 2. What we understand from SEBI is that the category 1 remains the same. Now category 1s of pension funds, sovereign wealth funds and all, or multilateral agencies which come under category 1. Category 2 is more of private equities and other foreign investors which are coming to some jurisdictions. So what they have done, they've taken some of the entities of category 2 and clubbed it with category 1.
Okay.
And the remaining category of category 2 has been clubbed with category 3 to make it only 2 classes of FPI instead of 3. So again, it's entity-wise classification which has shifted, and that's the reason classification has come down to 2 rather than level of KYC norms required for that. Coming to the second point, which is the...
So just before we move that, so the street is agog with changes having been done for the FPIs which will help flows into the equity markets. That hasn't happened. That big decision is still pending, right?
You don't put money because registration become easier.
Precisely,
right?
I just wanted to drive home that point, Sajid. Very important to drive home that point.
Yeah, because okay, you've made life easier, but that comes in when you go for registration or re-registration, or you're coming up for renewal of the process. Suddenly tomorrow I will be allowed to that will open up a floodgate of money. Is not going to happen because FPI take or institutions, investors take decisions based on
the returns that they will get,
and
not necessarily
the economy, and not necessarily entry.
Okay.
If they want an entry, they will go through any process to get an entry, right?
Well said.
Now you're basically easing the entry process. Yes, some new FPIs or new funds who want to come into the market can do that, can do it much easier than earlier funds. But again, how much of money is waiting outside is no one's guess. The second thing is that they made some of the offshore funds of the Indian mutual funds to allow them to invest in India. So the money which is going to offshore funds can be invested into India through an FPI license. So these funds will have to take FPI license. So which basically means any investor who is trying to invest in a Apple or Google through those funds, now he's investing back into India. I don't know why he will do that, because there is a currency risk attached to it, there is other costs attached to it, and he would rather go through an Indian mutual fund than to come through that route. But yeah, the regulators allowed those funds to come and register as FPI and invest in the country. So the second part is the credit rating agencies part. That is important, very important, because what the regulators now said is that credit rating agencies will have to take a undertaking from the issuer that they will which will allow them to access any financial details or details of the borrowing or the instrument from banks or any lenders.
Okay.
Now earlier what used to happen is that lenders used to say that there is a confidentiality agreement between the lender and the issuer, and so they cannot share it with CRA. What SEBI's new regulation will now say allow is that they will have issuer will have to waive off the confidentiality as far as CRAs are concerned, and so the details of that will have to be shared. Now again, there is a lot of ifs and buts in this. I don't know how many banks will comply with it, because banks comply with RBI norms. Now this norm, whether banks will comply easily, is something which we'll come to know, but that's something which is there. The third one is the buyback thing, which is a clarification which has been done. There's basically said, as I was saying yesterday, 2:1 was the debt equity ratio required under the current guidelines on a consolidated basis. What SEBI has done is that segregated the financial services subsidiaries from that, and then companies will have to calculate the debt equity ratio. But the financial subsidiaries which have been segregated together should have a debt equity ratio of under 6:1. So that makes it a little easier for some of the conglomerates who are trying to do a buyback.
And the likes of L&T, etc.
L&T, it could be Bajaj Group, all those guys. But again, it's again a call which has to be taken by those companies because of the buyback tax which is coming.
Okay. Sajid, thanks so much for taking the time out and giving us that perspective. Sajid Mangat, he told you yesterday about what to anticipate. There was at the press conference, and today bringing you the finer details. Mind you, nothing's changed for the FPIs in terms of money coming in. That big decision is still pending. However, something changed for Tata Motors yesterday. If not anything else, fundamentally, then it is the stock price, which is back to where it was 9 years ago. So what's caused the Mumbai headquartered automaker to fall short of all expectations, especially since it's one of the most diversified portfolio from JLR down to small good carriers. Yatin Mota is here to tell us more about it. So, Yatin, this is quite a fall from grace, so to say, for the stock. It was astounding, the fall.
Yeah, and Neeraj, this is probably that level when the company really acquired JLR 10 years back. We are just a few points away from that 10-year low. We can safely say it's a 9-year low. Let's talk about this in two parts. The Jaguar Land Rover part first. Of course, we have been seeing that JLR has been missing, the overall sales volumes. There has been pressure in the international markets, but it's not JLR alone. If you look at companies like Daimler, which is, the maker of the world famous Mercedes, their, first quarter EBIT was down nearly 40% year on year. Their overall volumes recently were, broadly down 3% year on year. Not only that, we also have the Volkswagen Group, wherein we have seen some pressures coming in, especially in the European market. Now, if you look at the other auto majors, including auto component makers in the US as well as the European Union, they also have been talking about a slower 2019. Of course, most of them are expecting some recovery in the second half, but not that much of a recovery which they expected, to have earlier on. On the valuation front, let's talk about Tata Motors versus, the likes of Daimler as well as Volkswagen, the nearest peer to JLR. We have, taken the data from Bloomberg, and you can see clearly from the chart which is on your screen that on an EV EBITDA basis, Tata Motors is not even cheaper than, Daimler's and Volkswagens of the world. Of course, they have their own problems, but, Tata Motors, a majority portion of their SOTP valuation, their majority revenue is still coming from JLR. So it is probably, fair to compare, the EV EBITDA multiples for all of them. There was a period when EV EBITDA multiple for Daimler shot up, but still, EV EBITDA of 3.5 times roughly for Tata Motors at this point in time, 2.5 times for companies like Daimler. Volkswagen is nearly 2 times EV EBITDA. So clearly, it's not cheap. Even if the stock is falling, do not think that the stock is coming at a very cheaper valuation. Of course, the other two big moving parts for Tata Motors is the entire piece of Brexit. No deal, a hard Brexit is something that everybody is talking about at this point in time. There is a political turmoil in the UK. So, there could be a lot of things that could change from the Brexit perspective. There could be tariffs from the EU, tariffs from UK to EU. So, a lot of auto ancillary portions come in from Germany for JLR, and JLR exports a lot of things to the European Union. So, in that case, there could be some potential cost disruptions that JLR could face. US tariff and the trade war between China and US could again lead to certain kind of tariffs. That is again something which could cause disruption in the key markets like China. Overcapacity and tighter liquidity in the global market is something also which could impact JLR. Of course, recently, which is last month, we saw Moody's downgrade JLR to B1. The outlook is negative here. And the reason here is the credit profile is expected to remain under pressure moving forward. And more importantly, the management guidance regarding free cash flows that has been, getting delayed. So probably that is the reason why now even the credit rating agencies are slightly cautious on JLR. Talking about the recent sales, let's talk about the year-to-date sales for JLR. They have not been great. In fact, if you look at the geographical breakup, we have seen the European sales were down 7%, Chinese sales were down 19%, Europe is down 8%, except for UK. All of the markets are looking weak. In fact, the JLR sales year to date, which is April to July period, is down 4% year on year, similar to what we discussed earlier when it comes to Daimler. Margins also, if you look at the last quarter gone by, the margins were at a multi-quarter low. In fact, from levels of 7-8%, the margins have halved to the first quarter. So that is again a concern. The management has been talking about EBIT margin range of 4 to 5%. They have not been able to do that. In fact, last quarter we saw negative EBIT margins coming in for the Tata Motors consolidated entity, and this is something which is a worry point from the earnings standpoint for JLR.
And not that the India and the consolidated numbers look much better, Yatin.
Clearly, we know the position of the domestic market. There has been pressure in the commercial vehicle business. In general, there has been a slowdown overall for the domestic market, which is again led to production cut at various plants of Tata Motors, including Pantnagar, which was announced. Of course, again here we also have seen that the unfavorable rating cut also applies to Tata Motors because that is a consolidating entity, downgraded recently to BA3 by Moody's. The reason is clearly the time taken to be free cash flow on a consolidated basis. Also, if you look at Tata Motors consolidated entity, margin pressure has been there not only for JLR but also for the standalone business because of higher discounting in the marketplace. And for the Tata Motors consolidated entity, let's talk about the return ratios, because the return ratio will determine the course of the stock price movement. And if you could see the chart on your screen, from a double-digit return on equity and return on capital employed, the company has turned negative on return on equity in FY19 because of the exceptional losses and write-offs that the company has taken. Not only that, in the last 5 years, we have seen the lowest return on capital employed. The return on capital employed now stands at only 5% as on FY19 basis. So clearly, the return ratios have been hampered adversely because of the slowdown in JLR as well as the domestic business profitability. So clearly, it's not only about margins, not only about the volume slowdown, but also about the return ratios, which have been now in very low single digits from high double digits a few years back.
Well, let's see what happens to the stock in the near term. Yatin, thanks so much for putting that into perspective. That's with regards to Tata Motors, one more auto company which is facing issues. That's all that we have on First Word today. But, well, lots more lined up and we'll talk about that. But as we wrap up First Word, an important point to notice, former Finance Minister P. Chidambaram was picked up by the CBI for questioning in relation to the INX Media money laundering case. This was shortly after the Congress leader made a dramatic appearance at the AICC headquarters and addressed a news conference. Here's taking a look at all that transpired yesterday.
As much as I believe in liberty, I also believe in the wisdom of our judges. So, friends, until Friday and beyond, let us hope that the lamp of liberty will shine bright and illuminate the whole country.
Totally a politically motivated witch hunt. This whole thing is being done only for theatrics and for voyeurism, for the pleasure of a few, and to divert the attention of the people of India from the serious issues.
We now slip into a short break. There's lots more lined up on Indian Open. We discuss markets and macros with Dhananjay Sinha of IDFC Securities. India's real estate sector grappling with severe liquidity crisis. We take a check on that with Irfan Razak of Prestige Estates. That's a very important conversation. And how is Wellspun Enterprises planning to tap government's water infra schemes? We speak to the Managing Director, Sandeep Garg. But after this break, a full tilt towards the day's trade.